So welcome everyone to this webinar by Hashim Pesaran on a counterfactual economic analysis of COVID-19 using a threshold augmented multi-country model. My name is Renee Fryman-Kibben and I'm a professor of economics in the Crawford School of Public Policy at the ANU and co-director of the research program on COVID-19 in the Center for Applied Macroeconomic Analysis with Joachim Vespignani. So let me introduce our speaker for today. Hashim Pesaran is a John Elliott Distinguished Chair in Economics at the University of Southern California and Director of the Center for Applied Financial Economics at USC Dornsife. He's also Emeritus Professor of Economics at Cambridge University and a Fellow of Trinity College, Cambridge. Previously, he was Head of Economic Research Department of the Central Bank of Iran, the Undersecretary of the Ministry of Education, Iran, and Professor of Economics at UCLA. He's a Fellow of the British Academy, the Econometric Society, the Journal of Econometrics, and the International Association of Applied Econometrics. He has honorary doctorates from universities of Salford, Goethe, Maastricht, and Prague. He has over 200 publications in the areas of econometrics, applied finance, macroeconomics, and the Iranian economy. His most recent book, Time Series and Panel Data Econometrics, was published by OUP in 2015. So Hashim will present his paper, A Counterfactual Economic Analysis of COVID-19 using a threshold augmented multi-country model, which is joint work with Alexander Judik, Kamia Mahadiz, Mehdi Rassi, and Alessandro Rebucci. The paper is number 85 in the CAMA Working Paper Series for the year 2020. And we are pleased to let you know that CAMA has just published its 100th working paper for this year. And the papers have almost 20,000 downloads this year. So thank you to everyone who has contributed and read our papers. So before I hand over to Hashim, I'd like to let you know that this event is being recorded and will be available on the CAMA website in the next few days. If you would like to ask a question, please use the Q&A button on Zoom and I will invite you to ask a question, or if you prefer, I can ask your question on your behalf. So I'll now invite Hashim to the screen, just getting to start his video, and we'll start the presentation.
Okay, thanks so much, Renee. And it's a great pleasure to be here to share this joint work with a number of my colleagues, which was mentioned. And I'm going to, I guess, be able to share the screen so we can start looking at some of the issues that we have been addressing. What I think is important that in this short period, which I think is important to have time for discussion and presentation, I'm going to basically look at a number of topics first that we have to address in order to deal with the problem of counterfactual analysis. And there are also, obviously I need to add, although it's not in the slides, that there have been a lot of work done in this area and more work is being done as we speak. I just want to single out the work done at the Center for Applied Macroeconomics by Warwick McEwen and colleagues there, and also the work done by Fabio Milani, who also used a TGVAR framework, although we will see that what we're doing is different from what he has done, which complement what I'm going to propose. And a number of other papers also we refer to, which is in the paper, although I am not really included them in the slides. So please look at the paper for a complete list of the contributors in this important area. So as the title suggests, basically the aim of this analysis was to find out how this COVID shock, which is a global shock.
Could we please just get you to press Control L so that the slides are full screen, please?
Control Alt, yeah. Okay.
Control L.
Yeah.
There we go. That's better. Thank you.
That's better? Okay. So basically, we wanted to look at the effect of the COVID, which is a global shock, in interrelated markets and its related economies. So therefore, relating markets from different countries together and also through trade the economies together and see whether that would have accentuating effect, or any country could have been saved from the effect of the negative effect of the COVID shock. So basically, we wanted to do a counterfactual analysis, but for that we need a model. And we obviously started with looking at the TGVAR, which interconnect these markets and countries, so that was a suitable framework. But we realized that there are limitations with the TGVAR that was available to us. Number one, we know that extreme shocks are likely to have nonlinear effects, while the TGVAR was log-linear, so therefore the effect of shocks would be proportional as it affects the outcomes, which clearly may not have been appropriate. So we wanted to introduce some nonlinearity into the TGVAR model. The second issue was that the way the TGVAR works with the common factors and also local spillover, it does it through trade patterns, which had worked very well. But when you try to identify a global shock, in fact, we realized it in a paper I did with Alessandro, which came out in the Review of Financial Studies this year. We realized to identify global shock, you need to allow both for local spillover effects as well as global effects, which then COVID would be a global factor. So we needed to modify the model to clearly explicitly distinguish between these two types of interconnection, local through trade and global, which everybody get affected, what we call a pervasive shock. Now, the third problem we faced, which we need to also address, was what is the size of the COVID shock? We haven't observed such a shock before. And the usual analysis people did in impulse response analysis, which they say, let's assume the size of the shock is 1 standard error or 2 standard error of the shock, would only make sense if we had history to estimate that standard error. So therefore, the classical way of doing impulse response analysis would not allow us to actually answer the question we set out. So to address that, what we did, we used the IMF revision of the forecast, which I'm going to explain a little bit more. So therefore, these are the contribution here, which is now, you can see set in this slide. But also, I wanted to clarify that why the techniques that many colleagues of mine, including Chen Chao at USC, has developed using panel data method. He first used this panel data approach in order to ask the counterfactual question, what would have happened if Hong Kong wasn't handed over to China? Which I actually edited it for the Journal of Applied Econometrics. So I realized at the time is a really interesting framework, but the problem with is for application to COVID was that requires have a control groups. In other words, you need to have countries which were not handed over to China, like the surrounding countries in the neighborhood of Hong Kong. But we don't have any country which actually wasn't affected by the COVID shock, one way or another. So that didn't seem to work. And also the Alberto Abadi's method, which is well established nowadays, which is called synthetic control methods, again, would not be available because you don't have a group of countries which you would consider as control. Now, of course, as the data becomes available, we go into the future, we can look at intensity of the COVID effect, maybe in 5 years or 10 years from now. Maybe historical data can help us, but that's not where we are now. We were doing it, in fact, 3-4 months after the COVID, we started looking at this work. And therefore, we needed to use a different approach, which we're doing now. So this is basically a very an overall view of why we are doing this work and how did we deal with these challenges. I'm not going to talk about result now. Let's just go to the first issue, which is nonlinearity. We all know nonlinear effect has been discussed in economic analysis. Threshold effects is a really reasonable thing to consider in many areas, and plays a very important role in operational research when people set pricing, what's called the SS curve. So there's a lot of literature, both theory and empirical, to support it. The trouble has been that in econometrics, we haven't found such effects in a sustained basis. So people have used the tongue approach, which is the threshold of regressive model, and Granger and Timo Tresverta later on developed the smooth transition techniques. And they didn't really come up to their promise as such. The reason I think it was that they consider a country-specific or market-specific threshold effect. While when we're looking at the COVID, it was clear that the threshold effect would be a global effect, not a country-specific. For that reason, we set about developing a measure of global volatility. Now, of course, we don't have a COVID volatility measure. I mean, we only have the implication of a shock, which is to do with the stock market, which we have reliable data. Of course, you could say, why not use other markets? I'm going to address that in a minute. And why not use other measures? Again, we actually address this in the paper, that our analysis is robust. And the measure I'm going to suggest to you, which we also have used earlier in a country-by-country analysis, not at the global level, it seems to work very well, and it's quite robust. The outcome is robust to how you slightly change these measures. So what is this measure? So this is what we call GRVET, which is global realized volatility. E means for equity, but you could think of it as a global volatility at the moment. So it's basically a weighted average of the realized volatility of all the countries who have major equity markets. Some countries, their weight W tilde is 0. W tilde basically is the PPP GDP weight of the country. It's like US get 25%. China doesn't have an equity market over the whole of the period that we are analyzing, so China is not included in this measure. But it includes all the other markets in Latin America, in Europe, and some Asian, Japan obviously, and some Asian countries. So how do we measure realized volatility? Goes from the work people have done in intraday data, which started with the literature in finance, and Shepard at Oxford and Frank Diebold and others have made significant contribution. What they show that if they use intraday changes and square it and add them up together, it's called quadratic variation. It gives you a very good measure of within the day realized volatility. When I studied this, when I'm developing trading system, actually 22 years ago, we looked at this problem. And what I found that there are problems with it intraday, because when you look at individual assets, there are jumps, there are irregularities, there are mismeasurement. So actually, people have spent a lot of time to clean that kind of data for intraday realized volatility, daily realized volatility. But what we're doing here, we're using daily data, which is not subject to these issues, and is also for the whole stock market, like S&P 500. So therefore, this daily data, which is really accurate, I mean, you couldn't find a more accurate measure of the equity market in a particular country as such. So it's averaging across lots of assets, and S&P also deals with collapse of some companies like Lehman Brothers dropped out of S&P when it went bankrupt. So it's a really good, reliable measure. So what we do, we take daily data and subtract the mean, which often very small, but we do it anyway, just to be accurate. Sometimes they may be important. And then we square them across the number of trading days within a quarter. So DT is the number of days within a quarter. And that's about 66, which is much better, a higher number than the number of daily intraday changes people use, which was every 15 minutes. So basically, I come to love this measure as realized volatility, although we were brought up with the gauge and arch type conditional volatility. I think this is a measure which I would recommend, and I've used it in a number of different areas and suggest to reasonably work well. So by averaging across the countries with the weight, we get really what we call truly global measure of volatility. Of course, it's to do with equity, but then we also looked at the same measure for gold. We looked at the same measure for oil. Just do the same daily changes, square them, add them up together, you get similar measure. It turns out that this is really, this measure either correlate with them or basically, or it doesn't make much of a difference if you have a weighted average of these measures as such. So there are a number of reasons to believe that's a good measure. Okay, so what we did then, we said, okay, if this is a global volatility measure, we need a threshold. When this volatility goes above a threshold, which COVID did as well, went above threshold, although our data goes from 79 to 2019, we have 40 years of data. We have 166 quarters of data. And remember, all these measured based on 66 days. So these are, then we then say, okay, we have a nice measure. So we call it a threshold effect. So the threshold effect Z is defined when this, our independent measure of global volatility, by independent, I mean independent of the output or any other measure, it's just, and it's lagged value. We don't put contemporaneous, right? That's the key. Of course, if you put contemporaneous, we get endogeneity problems. So we put the lagged value of this indicator, and we ask ourselves, what is gamma? Of course, we can estimate gamma many ways. The first time I did it, I said to myself, what is a rare event? Which then determine gamma. I said, okay, people say 1 in 100, I think is too low. I think it's 2 in 100, so 1 in 50 years. So actually, when you do the grid search, you get about the same number. So basically, gamma is a number where Z takes the non-zero value basically 4 times or 2 or 3 times during our sample. So we can, however, obviously we do estimate gamma in a rigorous way, and then we distinguish between advanced economies and emerging markets, because there is an argument that their gamma could be different, but we do not obviously estimate country-specific gamma, because firstly, it's not possible. Secondly, this is a common effect, and we pool it, so we do a panel version of the threshold effect. So what we get, you know, for advanced economy, we get 0.156, and that converts to about 3%, 3.5% of the quarterly data. And then for the emerging economy, we get slightly less, which is, you would expect that. You would expect the emerging economies are less able to deal with shock, and therefore they go over the threshold reasonably quickly. So anyway, the bottom line was, we find that, to my surprise, to be honest with you, that this measure, which is lagged value, it's only happened to be non-zero only 3-4 times the whole of the out of 166 quarters. So basically, you're getting 15 out of 19 advanced economies, highly significant, 80% of the sample. And we do estimate each country separately. So it's not just, this is what the data, the results are. So you can just see, firstly, everywhere is negative. It was interesting to see Australia is negative, but not as significant as other countries. Look at Austria, Belgium, you've got the T ratio, each of them separately calculated. If you do mean group estimation, which we also, you know, we know how to calculate standard error of these things, and, you know, from the work I've done with Ron Smith and others. So basically, you get really a robust 1%. Remember, is 1% is per quarter. So it says when there is a negative shock, which is extreme, it drags down the economy by 4% on average. So that's in addition to other cyclical effects. So we are not suggesting that normal negative shocks would not operate. This is on the top of it. In other words, when it's really extreme, the effect is 4% worse than you would have expected. So basically, if you then go to the emerging economies, you find this. The negative effect is always there. There are some positive numbers, but they are insignificant. But overall, there is a negative effect, but it's not as prevalent as advanced economies. But I think there's good reasons for it. We do discuss in the paper. I mean, one important reason is that there are local shocks which affect, like my own country, Iran. They are affected by sanctions, so that could have a different consequences. So there are local factors which are more important in emerging economies, which we are not addressing, although one could extend our work to deal with those local extreme events as well, like tsunami or earthquake or things like that. So if you then look at the relation of this global volatility with output growth, you'll see that it obviously, we saw empirically in terms of the econometrics, which works. You can just see graphically that also works. And it's always, we can look at this is the US, the red data is US output growth. And the red here on the right side is the global output growth, which is a weighted average of the countries in our GWAM data set, which is 95% of the total GDP. So basically, they do spike in the right places, but obviously we didn't, this is the COVID spike, but we didn't put it in. But it suggests that if our analysis was up to 2019 was correct, and the COVID shock would came along, we would have expected that the world economy in general would go down by 4%. just because of that, the COVID shock, without even doing any further analysis, purely from historical observations. So basically, what we then say, okay, that's good result. So we are encouraged by this result, but that is not the whole of the world economy. You need to also include in the model not just output growth, but also long-term interest rate, exchange rate, in particular for emerging economies. Exchange rate plays a very important role when there is a flight to safety. I remember Marty Dungy, which now with ANU, played very important role in helping me understand the effect of flight to safety when you have a shock, how the emerging economies get more affected through exchange rate and through a bond market, because they have to borrow and they may not be able to afford the interest rate. We could say interest rate could be different. You'll see it in our model as well. So I don't want to divert ourselves because of the time. So I want to finish, at least give you a feel what this model is about. So then what we did, we went back to the GVAR now. So in the GVAR, we used to have 6 or 7 variables, but we dropped the inflation and short-term interest rate. Obviously, these are not important, especially in the current environment. They could become important in future, but I thought for over the period we're looking at with the great moderation and so on after 1990, because our data stopped 79, so we can drop those, and our colleagues all agreed that that's a good idea. So what we did, we basically focused on output growth, long-term interest rate, equity return, all deflated by CPI, the real equity return, and EP, which is not the real exchange rate the way people define it. I don't like that because it confuses the domestic and foreign price together with the exchange rate. So this is just simply log of exchange rate, nominal exchange rate vis-a-vis dollar, US dollar divided by the CPI of the country I. So that's basically, it balances, you can then deal with very high inflation countries and put in line with the low inflation countries. So, and we don't even worry about co-integration. This is all growth rates. So they are all stationary. So what we did, we just modeled this in the GVAR. So this is a high dimensional problem because we have basically, I don't know how many countries we have, to be honest with you, but I know how many variables we have. Each country have got their own KI variables. But remember, KI may not be the same across countries. Why? Because like Saudi Arabia, they don't have long-term interest rate. China doesn't have a long-term interest rate. China doesn't have equity prices. So our countries have at least 2 variables, growth and exchange rate, but many other countries, advanced and some of the emerging, do have all the 4. So in total, we have 109 dimensional vector. And then we have 161 quarters because we use the 3 observation at the beginning of the sample for initialization. So if you want to think about the high dimensional problem, I mean, okay, I say people to do lasso and so on, everybody become like a fashion. Why don't you try lasso on the Y? Of course, this is a bar of 109 dimensional. I wouldn't recommend it myself, so we are not doing that. So we also want to identify counterfactual. It's very difficult to know how you do it without some structure. And that's why I think what Warwick and you guys do, which have a structural model, which is may some of them reduced form, is indispensable. You cannot just replace this by some high dimensional machine learning techniques. Sorry about this advertisement. Okay, so now we go to the global shocks. So we have 2 kinds of global shocks. Observed one, these are oil price changes, the rate of change of oil price, and then our global volatility measure. So we are not just including the threshold, we are also including GRVE, the global volatility measure, which is an independent measure, also in the model. So everybody gets affected by global volatility measure. So the threshold does it on the top of this. So what about the what you may call unobserved or latent factors we don't measure? So that's why the work I've done on capturing this common factor by cross-section averages comes to life here, and you can mathematically prove this is the right thing to do. So obviously we put lag values of these as well to clean up the effect of the common factor. So therefore, you can imagine you basically proxy the latent factor by the cross-section average of output growth, long-term interest rate, equity returns, and exchange rate variable. So therefore, these are, and the weights are obviously we use PPGDV. But the theory suggests it doesn't really matter. If you use equal weights, you get very similar answer. But obviously, it's better to use this weights. So then it's very straightforward that these aggregate, so there are two types of, let me remind you, G and Y tilde are common factors. Some directly observed, some indirectly observed through the cross-section averages. So then it's obvious that all these aggregate measures relate to the individual Y, 109 vector Y, which is world economy variable, through this W matrix, which is the basically trade weights or PPP GDP weights. Those of you familiar with the TGVAR, I call this a link matrix originally in honor of Larry Klein, who was instrumental trying to link the models of the world economy together. Okay, so these are then we have now on the top of this, now we have the local effects. You can see the local effects now is a star. Remember, these are different from these global measures. These are weighted average using the weights PPP GDP weight. Now we are using trade weights, so these measures are country specific, and that depends on the pattern of trade of each country separately. And we use the 3-year kind of average to become less. We don't want WIJ to vary too much for a good reason. I mean, there is an argument that for China, we did a paper again, which we looked at. If there's something emerging, you may want to change this W to change. But here, I thought for this sample, it's perfect. Okay, we thought that to use this. So that we use the trade weight. So also notice here, this Y star now linked through WIYT. So we have one W tilde, which is PPP GDP weights. And then we have another WI, which is country specific trade weights. It's like a spatial model, really. But instead of using congruity or closeness to each other, you'll be using basically the trade weights, which a lot of people discuss with me, but I don't use capital flows with blah, blah, but I think people stopped bothering me with that, but that's fine, using trade weights. So then we basically have to model the global factors, which is the G and the Y, we call F. We need a model for it. So we model it like a bar. And then these are the global shocks. VT are the global shocks. The global shock could be observed shocks here, or it could be, observed, or it could be just proxied through the cross-section averaging. And then we get up to this model, and then now we add in the threshold effect. Can you see? So the model has the factors and the threshold effect. So then what we do, we replace F here to get rid of endogeneity. So we end up with VT. And then the econometric analysis, I can assure you, will show that therefore I can take the V, which is the residual from the factor VAR model, it can be treated as weakly exogenous. So basically then we just simply run a VAR X model for each country, including VT, which is the residual from this regression 12. Okay. Then we also add in the lag value of the threshold one. Now we estimate this model separately for all the countries, and then we then stack them together. Now we need to solve it, stack them together so they get back to the Y. Notice here, then we actually resolve the, finally, when we go through all of the steps, I'm sorry about jumping. So basically X is now the Y, which is the 109 variable, and the GT, which is 2, realized volatility and oil prices. So therefore, the model now solved for all of the Y variables, which are all endogenous variable in the world economy, plus the 2 global observed measure. The later one gets resolved, right? Because the later one are a function of the data anyway. So therefore, that is a gigantic bar. If you don't want to call it global bar, call it G for gigantic, because this dimension of it is 103 by 103. Now we have managed to get G and the lambda and all of these parameters basically using this device of the TGVAR effectively, which is multi-country modeling. I don't really think that it's possible to do it that much different because somehow most people don't allow for unobserved common factor. They don't try to link everything together, and that's why they get away with it. But if you want to deal with it properly, that's what we end up getting. Of course, there's misspecification. There may be other factors. There may be the weights may be changing. So obviously everything we do is approximate. I'm not claiming this is the gospel truth. But remember, we have to combine the E with the shocks. Now, what is the E? Now is composed of the global shock and country-specific shock. That's how we are able now to do counterfactual on the V and assume epsilon are idiosyncratic. So basically now then we estimate the gamma now within this model again, distinguishing between advanced and emerging economy. So a lot of computation has been done, which actually Alex Chudik did all of them really in a very timely manner. So therefore, we then got now we need to talk about the last question. We have a model now. We are allowed for the nonlinearity, as I promised you. Of course, there will be minimal nonlinearity, but I think it's important one, as I showed you, it makes 4% difference when this rare event happens negatively, which is big number for the world economy. So basically now what we do, we now want to identify the COVID shock. So this is where my other colleague come in, and then they actually, we came out that one way would be to basically go and look at the IMF. So what we did, we looked at the IMF forecast of the output growth. Remember, IMF doesn't forecast all the variables in our model. It doesn't have forecast for exchange rate, equity markets, and long-term interest rate across all of the 35 countries we have in our sample. But they have output growth. But we can recover the other shocks through the model, like impute the other shocks from the data that we have for IMF. So what is the output data from IMF? Is basically output growth. I'm looking also at the time. Is output growth of the forecast, which was at the beginning of, well, really based on the data on 2019, they forecast the output growth across countries. And there are many countries that we have in our sample. And Mehdi Raisi, who is one of co-authors of the IMF, he helped to get the data for all of the countries we have as much as possible in our sample. So then what we did, we just look, IMF didn't know what is COVID going to happen. At least there are no indications that allow for it when they forecast at the end of 2019. But then in the April of, I think it was April, if I'm not mistaken, they came out with the revised forecast downward. When I was discussing with some people, say, well, but the IMF also revised the forecast downward again in June. I said, well, if you use the June, the result is worse than what we have. So therefore, whatever you see, you could say, okay, it could have been worse. So what we did the end of April. So therefore, we saw how much IMF thinks output growth is going to fall. We said, okay, let's assume that IMF, the forecast is unbiased, which I think probably is reasonable in the absence of a COVID shock would have been, the mean of it would be probably right. So then we said, okay, if the forecast is unbiased, the revision has to do with COVID effect. So therefore, we identified the size of the COVID shock from the revision of IMF forecast. Now, you may take issue with that. I probably would agree with you, but okay, that's what we did April and January. So therefore, these are exactly the date the forecasts were released. So we use this KIQ, which is for the quarter 1, 2, 3, because IMF does a forecast for quarterly for 1 year ahead. So we use 2 years ahead, but we use the 4 quarters of 2020. So these are the numbers come from IMF. So we have this data. So from this data now we back out the other shocks. Let me not spend time on it because I'm running out of time. I want to show you a result and stop for a discussion. So basically, it's very straightforward because the model is coherent. So we can find out the conditional expectation of the variables IMF didn't forecast, conditional IMF forecast. Then we find out what the numbers are. So that's what this matrix allows for that. It deals with all of the cross correlation of the errors in the model. So spillover effect would then show up both across markets and across countries. So that's why this is the gigantic matrix. These are the 100 and I think 2 or 103 by 103 matrices. But remember, we don't invert these matrices. We just need, this is a selection. These are the variables that IMF didn't forecast. So we have all of them. So now we are in a position of the size of the shock. We have the model. The size of the shock we know not only for output growth, for all the other we imputed. Then what we do, we then say, okay, we do a conditional forecast based on the revision, the shock, the COVID shock, and compare it. What if there no COVID shock happened? Remember, our data only at the end of 2019. We don't use any data whatsoever except the IMF revision of the forecast in order to define the size of the shock for beyond 2019. So whatever you see, they are really counterfactual. It's not a forecast. So what we do, we then compare it to the baseline, and then what we do, we just, to allow for uncertainty, we simulate the model. You remember idiosyncratic shocks can be simulated. We don't know what the COVID shock is, but we know what idiosyncratic shock is. We know what the global shock we observe in the past, what sort of standard error they have. So we can draw lots of shocks from all of these variables, then simulate the model forward up to 2 years ahead. And then we compare the one we shocked with the COVID shock size from IMF revisions compared to the usual conditional expectation, which we didn't shock. Of course, this is now random variable. Then what we do, we show the basically, sorry, before we go to that, then we show the distribution of this counterfactual outcome. So this is stochastic. So stochastic simulate this across many draws. I think we use, I can't remember, 1,000 draws. So these are the countries included in the model. Is almost all countries which there is data we have included in the model. Data having quarterly all the way back to 1979. And the numbers in front of these countries say how many variables they had in the model. So these are the countries who had equity market and long-term interest rate. Like Finland doesn't have a long-term interest rate. And if you look at the countries in the south, like emerging economies, very few of them have equity market even. So we do allow for differences in the number of variables across countries. So then what is the outcome? So we find that, let me just show you a graph because we can talk about it and go back to the beginning slide, which summarizes the result. So basically the outcome is you can look at world economy, you look at advanced economies, we can look at each country. Remember, we can look at any country in the model. Look here that it is, remember we are sitting at 2019, and so that the only information we have is the size of the shock, nothing else. So for that, it said that the world economy would drop 10% and it recovers, but doesn't really go all the way. And then even if you go 2 years ahead, it still is below the par. Of course, there is a randomness here. So this is the bound here, shows you the sort of stochasticness of the model, and both parameters and the stochastic nature of the shock. Now, if you look at advanced economies, worse. So basically the reason is that the China came out the data then prediction was actually 5%. They went up by 5%, We didn't have that data, but we more or less predicted it from this model. And then if you look at euro area is worse, like for example, euro area is 15%, United Kingdom drop of 15% relative to baseline. If you look at the US, is about slightly better than Europe, but not that much. And if you look at China was different, so that if you look at advanced Asian Pacific is worse, less affected. Even if you exclude the emerging Asia without China, still they are better off. I think we were discussing with some colleagues that Vietnam and other places also dealt with the virus better. So therefore, the Southeast Asia is doing better. Maybe Australia is benefiting from it because they have lots of trade patterns with them. As we see that trade patterns are important, is not the effect that you have is that there's a direct effect which comes because you have to do lockdown or social distancing or close down some of the businesses. That's the direct effect. Indirect effect is because your neighbors are not doing very well and therefore the trade is falling. So therefore you need to allow for, the model obviously allow for both. So what we did, we look at Sweden. Let me just go quickly to this. So we said, okay, a lot of people say Swedish model, they didn't follow the lockdown. They were much less serious about social distancing. They let their citizens to decide. And maybe, that helped. But okay, if you look at what we did, we basically try to address this issue. We say, well, okay, let's put 0 COVID shock for Sweden. So that is exclude Sweden from shocking from COVID, as if COVID didn't happen in Sweden. But this is when treat Sweden like everybody else in terms of the size of the COVID shock. So you will see that there are differences, but there's more uncertainty here. But it doesn't really help Sweden that much. The median maybe would be 1% less than if you compare without. So basically, nobody is immune to the long run. Immune to the sort of a global shock, especially through trade. So in a way, if the COVID doesn't get you, trade gets you. So basically, this is what we found, that the effects are large and persistent. And I think, we did this based on the, a few months ago, and I think the results coming out now gradually seem to be supporting it. If you look at the forecast, which is different from the counterfactual, which compared with the baseline, now we don't compare with the baseline. We say, what is the forecast? So you see that China is recovering and go back to 21, basically maintains growth. Of course, it's assuming China can hold the virus away from their doorstep, because the world is connected. As soon as they open up without the vaccine, the virus would spread. So in the US, is basically the prediction in this model is we are still going to be increases, but it's not going to be back to the level it was before the COVID, even in the end of 2021. We don't know. This is the forecast now. It could be revised. UK is a bit worse. Euro area is a bit worse, actually. So, which is matches with what we observe at the moment. So then we also look at the whole advanced economies, other advanced economies, and so on. Again, emerging economies without China, they are going to do better, as you would expect, and so Latin America is going to do not well. The details are here. I'm looking at my time. Finally, we also looked at the effect of the long-term interest rate. I don't have time to cover that, but I flag it. I think it's important. In fact, Jordan, we use the data. Oscar Jordan has got the paper with Taylor and others. He sent me a new paper that he is written using a pandemic over the last 400 years. And he finds similar effect that we find in this counterfactual, so which is satisfying. Which we didn't address it in this paper because we didn't know about the paper the new paper by Oscar Jordi. So basically, at least new to us. So basically, what you see here, that emerging economies are more fragile because the interest rate for them could be more adversely affected than for advanced economies. So in other words, going back to flight to safety, it is kind of flight to safety is operating in a bond market in a sense that the emerging economies, if they have to borrow in the market, they may have to pay higher long-term interest rates, despite the fact that long-term interest rate in the advanced economies are the historically, unprecedentedly historically low. So therefore, I think there are implications for long-term financing, debt financing of the basically of the emerging economies. So there is a long-term interest rate has been going down, but it may not be symmetrically distributed. So we have data on that. So I'm going to start, but to go to the beginning and just flag some of the results, just have it in front of us. So when people ask questions, I can sort of go back to individual issues that I raised, the three major issues, and the results which already have given to you as far as given the time allowed. And here are the summary of the results. I see one of my co-authors, Alessandro Bucci, and I think Kamyar is there, and I'm hoping they come in and help me, which I'm sure I need all their help as much as I can. Thanks very much for listening to me. So I pass the microphone, as it were, to Renee. Thank you, Renee. I hope I stood with my time. I mean, maybe 2-3 minutes above, but I don't know when I started, sorry.
No, that's fine. We'd love to hear what you have to say. Okay, so if you'd like to ask a question, please put the question in the Q&A, and we can either invite you to the screen to ask a question, or I can ask on your behalf. Does any of my fellow panelists want to ask a question? Maybe Warwick, we'll start with you. I might just stop.
Yeah.
Go ahead.
Yeah, thanks, Renee. Hashim, a really interesting paper. I like it a lot. And the numbers are very, very similar to the structural results in our second paper, which you refer to very kindly. It's really surprising to me that a lot of financial markets seem to be very optimistic about what the real consequences of this shock has been. And I just wondered what your reaction was. Do you think the introduction of a vaccine has really changed the nature of your results? My view is that it's a long way off before it has any impact, but I was just curious whether you think if you ran this again with some sort of vaccine intervention, would you get very different results or very similar? Thanks.
It's a very good question. Actually, I've been thinking about it over the last few days, especially with the two independent vaccine discovery, Pfizer and their collaborators in Germany, and also the Moderna. But amazing, they use similar techniques. They got 95% effectiveness and very little negative or harmful effects. So I think the vaccine going to be instrumental, but I don't think that it would be that quick. Let me go through my thinking, so maybe we can then discuss it. That's a very important issue. I mean, these models is counterfactual. It doesn't tell you what's going to happen. There's could be another shock. So we could run this model and put a vaccine shock, which could be positive shock, right? Because what is the size of the positive shock, right? We can do the modeling. In fact, maybe Alessandro is saying that we could easily do it in our model. We can act at a positive shock in 2021, because the vaccine is not going to be effective in any way till 2021. It's obvious, because they are going through, if everything goes well, it's going to be covering by, in some advanced economies, US, EU, and Europe, only some front workers, nurses and so on. So, okay, that's not going to change economic activity because they're working anyway. So basically, that's not going to have a little effect. So you have to think about, therefore, the second quarter of 2021 and the third quarter of 2021. I think we will get some positive shock, in my opinion. But remember, the virus is going to spread. And we had this conversation. I think Australians shouldn't be complacent at the moment. In my view, I have also other studies of the virus. The virus spread very rapidly without you thinking. As soon as you think you got it under control, unless you get it to zero and manage to do it trace and track at very low level, it comes back. So this virus is going to be with us for a while. So the vaccine is obviously going to give some positive investment outlook. For some people, the stock market will go up, but it's not going to be commensurate with rise in economic activity till, if you think about it, the summer and maybe fall of next year. That is my calculation. How much? I don't really know. I mean, this is the question. What is the, in fact, I gave a talk about the virus to some people, and I asked the people, we don't see everybody, I said, excuse me, if there is a vaccine and you get vaccinated, would you behave as if the COVID doesn't exist anymore? Very few people told me that they would not take any care. The reason is we don't know whether this vaccine is going to protect other people against us. So since we all don't know, when we go around the street or go in an aeroplane or work in workplaces, we don't know whether other people will come across, they have the vaccine. We know that Americans, 30% of them said they're not going to take the vaccine. Then the vaccine is not going to be available for a lot of advanced economies. So to come to normal condition in the way we define trade and travel, we are a year away from it. So I don't think this is not going to be much affected. But of course, no, I'm not saying that not affected at all. I think there would be some positive output effect coming in because of the, people get excited about things, therefore they do investment and that sort of thing, which is obvious. They bring forward some activity. And the other thing is, I was thinking about it, the vaccine itself adds to the GDP, although it's sort of, basically you solve a problem, but it's not really, it's not welfare improving as such, in the sense that if the COVID wasn't there, it would have been better. We could have spent this money on education of our people. But that's another effect. The GDP is a funny concept, as you know. But I agree generally with your tone of the question, if I understand correctly.
So we have a question from Kalyappa Kalirajan, who is at the ANU. Among the emerging Asian countries, India has been affected severely. The results seem to be contradicting this reality. Is this due to data constraints?
I don't know whether, did we have, I think the problem we had India, let me just go look at the list of countries. I mean, I haven't looked at the Indian, let me just go and see. So basically, we have the India, but the India doesn't have equity market in our model. So that's a problem in the sense that we don't know, we don't have a very good measure of volatility of India, right? So the only thing we rely on global effect, right? So I wouldn't try to put as much weight on advanced economies, the ones I showed you, as I would do on individual countries, right? So I don't think you should take all of the components of the TGVAR literally, because the quality of the data and quality of the modeling required to deal with the special effects of these countries, we don't deal with. So I think I would rely more on grouping of the countries as we did, and some major economies like US, Europe, and maybe Japan and China and so on. Obviously, would include Australia because of advancedness of the economy. But I'm not going to be too confident about the result we have for India. I don't think we showed the Indian result, but I'm sure I'm happy to let you send you, if you send the email to me or my colleagues, we'll send you what we have.
Okay, I think Joachim, you have a question next?
Yes, I have, yes. My question is, I mean, one of the global variables that you include is oil prices. And an interesting thing that happened with oil prices in the last year was the sort of war price between Russia and Saudi Arabia, which actually was a supply issue that actually was making oil prices more volatile than usual. And I was wondering if you expect any effect for this, because having oil prices, you don't have the demand and supply, you just have the price. I was wondering if, well, first of all, I mean, a possible robustness analysis is just to use the commodity prices index from the IMF rather than oil prices. I was wondering if you have any thought about that. Or you perhaps don't expect any impact because it's only for a short period of time.
Let me explain what we put in the model. We didn't put oil price volatility in the model. So basically, I did explain that when we looked at the oil price volatility, we did include commodity volatility. We look at even gold volatility. In fact, I thought because of flight to safety, gold could be a good measure. Unfortunately, none of them worked. So we don't have them. The only volatility measure we have is equity global volatility. Okay. What we have in the model is the oil price change.
Yeah, but that will be.
It's not the same. It's not. Look, it's not the same. Well,
it's not the same, but it may have the same impact in the model.
Okay,
That's what I mean.
So let's just talk about the level of the oil price. You see, the thing is that when you get all the shocks, we had it also during the 2007-8, oil price dropped. I mean, a lot of people spend a lot of time in our profession to find out what is the cause of something, right? I am old enough to know that I'm skeptical of anybody knowing what the cause of anything is. What I look at, I see it drops. So the fact oil price dropped this time, right? It could be because of the Russia and Saudi Arabia. Even if they didn't have, it could have dropped anyway. I'm not going to bet on it one or other. But if you compare it with what happened in 2007 and 8, it matches it. Right. Okay. So basically, in a way, the oil prices, commodity prices, and equity markets are become very highly correlated during extreme events. In fact, I have a PhD student who's on a job market. His name is Rashad Ahmad. I want to advertise it because what he done, he actually used 5 shocks instead of 1 group, and then he actually arrived at a very similar conclusion because when you don't need these shocks, in other words, they're not a rare event situation, it doesn't really matter. They don't really play that much of a role. But when they become important, they become highly correlated. So that is my difference. I'm not saying that somebody could analyze it more and find out if China and Saudi Arabia didn't get into each other, the fall in oil price would have been less, and therefore you would have a different outcome. I somehow doubt it, but it's possible.
Okay. Now, just following up a little bit, if Renee allow me, just a short question. One of the things that happened is that also in US you have all the shale oil. There was a big drop in production of oil in US in this period, and I was wondering if this is one of the reasons why the U.S. economy is going to be affected more than others, because there was a big drop in oil production in U.S. from the. I mean, given that it's just not economically viable to produce oil in this. Yeah.
But I think it's true. But remember, U.S. economy is quite large economy, so the
Yeah.
oil sector is not, significantly large. Especially, you talk about those the shale oil producers. They would stick on doing it, so therefore they go out very gradually. So, but there are financial implications of that. But the Trump government helped them quite significantly.
That's right.
So in a way, if they hadn't helped them, you would have been probably right. But I think if you look at this result, U.S. is not doing that, it's doing a slightly better than Europe. So, I mean, it's difficult to see from this graph, but if you go down, you find U.S. is probably less affected. It's a bigger economy, it's more diversified, and a more flexible labor market. So, and then also I mean, if the Trump had played a better role, in my view, in terms of policy, economic policy and COVID policy, U.S. could have been even better. They didn't. So I was surprised that U.S. is more or less as badly affected as Europe, because there are more resources, they're more diversified, and in a way, and the flexible labor market and so on. So all these things people have said has helped U.S. in the past. It's helped a little bit, not that much. But you may be right that that could be also a part of the story, but I don't think it's a significant part. Is a part, for sure.
Okay, okay, you have a question next.
Yes. Yeah, thank you very much for very inspiring talk. It was really impressive analysis with many interesting features. Particularly, it was very interesting to introduce threshold effect. And I wonder how important is to capture the threshold. More specifically, I'm interested in the difference between the result with and without the threshold model.
Well, it's a good point. I mean, we could try to run the model exactly to answer your question, right? So I don't know precise answer to your question, but I think if you look at this table here, which I showed, let me just go to it, especially for advanced economies, you can just see that, remember, it's a quarterly, so it's about 4%, right?
Sorry, we don't see that result. I mean,
you don't see this? Let me share it. How about that? Do you see it now?
Yep, that's good.
So you can see this is the number I'm looking at, minus 0.01 per quarter. So this is about 4% per annum. So this result suggests that putting a threshold would basically would have got a worse result than if you don't put a threshold. But how much, I don't know, because when you don't put a threshold, other variables in the regression try to pick this effect up anyway, right? The volatility itself is going to pick it up because the threshold is correlated with volatility, which we already included in the model.
Yeah.
So basically, I don't know the answer exactly, but it would be important to put it in because it captures.
Definitely.
Yeah, it captures it. And I think this is really, to me, I mean, I've done a lot of applied work, most of you know. I mean, to me, that was a really pleasant surprise. Look, everywhere is negative. And 80% of the country is significant. I mean, people who have studied nonlinear threshold, I haven't seen anything like this. Because what they do, they put in country-specific effect of the lagged output growth, right? It doesn't play very role. So this is not a lagged output growth. It's additional variable outside the output growth, which correlate with output growth. What it's saying is saying that during extreme events, this uncertainty heightened, that this heightened uncertainty is this additional effect, negative effect on the economy, which it seems to be a good idea to capture. Remember, when we put it in the model, we included like a lagged value, just remind you, is a lagged value, not the contemporaneous. So it says that it's going to have an effect. So it's like a warning signal that if there is an extreme event happen this quarter, for sure, output next quarter will be lower. You cannot avoid it. That's what it's saying to me.
Yeah, thank you.
Yeah.
Okay, we don't have much more time, but there are two more questions that I can see in my chat. One is from Laurent Ferrar, who asks, all variables in the VARs are real except for long-term interest rates that are nominal. Is there any reason for this? And the final question is from Shuping Shi. And she says, thank you for your interesting paper, Hashim. The global factors, oil price and financial market volatility, are not independent from the COVID shock. I'm wondering whether we need to worry about that in the model. And secondly, unfortunately, the COVID shock does not only last for one period. Is it possible to take the duration of the shock into consideration?
Okay, I didn't get the first question. If you're ready,
so all the variables in the VARs are real except for the long-term interest rate, which is nominal. Why is that?
Well, I mean, the inflation has been almost zero in the US, and that's what the long-term interest rate running it, basically. We can easily subtract the inflation from it. I don't think the result changed, but it's a good point. We could try that as a robustness check. Thanks so much for raising it. But I think the equity price is obviously, you could also look at excess return equity, but we're not modeling asset pricing. We're modeling the effect of these variables on each other. So I think we could consider subtracting the US inflation from the bond market. Now, in terms of the question that was about the correlation of the shocks, remember we get the COVID shock from the IMF revision. So the correlation that we talk about, there is no COVID shock in the past, so there is nothing to correlate with the past shock, right? So I may misunderstand the question, but my understanding of it is we take the COVID shock from the revision of the IMF forecast. So in a way, you could be arguing that that's not a very good measure, but I don't know what other measure. The other question was about we don't do one shock, we actually do cumulative shocks. So therefore, we are not saying the COVID is only the first quarter. So what we do, if I can find it, here we are. So notice here, these shocks is quarter one, quarter two, quarter three, quarter four, and then we move on. So therefore, we do allow for the shocks to be still present. All the size of it would be dependent on the revision, because remember IMF forecast quarterly and at annual level. So we do allow for the COVID shock being persisting. If I just go back to the discussion I had with Warwick, that basically you can now go to the quarter 5, 6, 7, 8, and then say in quarter 5 and 6, this is the same negative thing. We could look at the revision of IMF or our own model and incorporate it, and then say because of the vaccine, quarter 7 and 8, the shocks could not be that negative, could be positive even, right? So this is what we do, right? So we could, basically, because we have a model, we can impose any shock profile and then simulate. So we didn't just look at one shock, one period shock. No.
Okay, I think we've come to the end of our time. Thank you so much, Hashim, for a really fascinating discussion. But before I formally thank Hashim, I'd like to let you know that our next webinar is on December the 4th at 10 a.m. Australian time, and it will be delivered by Adele Morris from the Brookings Institution with Frank Yotso and Warwick McKibben from ANU. And the topic is on the future of climate policy under a Biden administration, some implications for Australia. So I'd just like to say thank you once again, and I know some of your co-authors are here as panelists and in the audience as well, and thank you for them and their work as well. So please join me at home in thanking Hashim, even though we can't hear you. It's good to spread some good karma out there.
Thank you very much.
Thank you.
Thank you very much indeed. Thank you. Bye-bye, Rennie. Bye-bye, and everybody else. Bye-bye.